Hi everyone, welcome to this new coverage. As usual, I will be sharing with you my view for this week, for the coming days in the market, and what we have to take care about, both fundamentally and technically. So let's start. I take a look at the calendar. Here it is. Of course, as usual, there are a lot of things going on around, and Edward mentioned them even before we discuss whatever the macroeconomic picture is, right? One of those things is the fears of a hard Brexit, right? Sorry. Last Friday, we have a wild swing in the pound. It lost average 700 pips in a matter of minutes at the beginning of the Asian session. uh, they're still talking or discussing whether it was an algo trading, a fat finger, thin volumes, or a combination of all of those. The fact is that the sentiment towards the pound is negative, and although we should not expect much more of this kind of wild swings, indeed the pair is poised to extend this decline, and the pound will probably remain under pressure, right? Because of fears of uh, how the Brexit will result and which will be the consequences. There's a lot of uncertainty. We had a couple of weekends ago, not this one, but before the previous one, we have news from UK Prime Minister Theresa May, who said that she plans to launch Brexit by the end of March next year, right? And well, there are some headlines today pointing to the case that, in fact, to trigger the Article 50 of the Lisbon Treaty, the UK needs a parliament approval, Um, and there, as I was saying, there are some headlines today suggesting that they may appeal. The government will go directly to the court, right, to avoid going through the parliament. If the UK decides to go through the parliament finally, uh, it has to visit different chambers, come back and forth. That means that it will take a year or something like that to even start triggering the Article 50, to discuss when to trigger the article. So that will prolong uncertainty, in my view, and probably mean that the pound will be under more pressure. Indeed, a hard Brexit, which is the UK also leaving the common market, the single market with the European Union, indeed will harm the economy to limits we don't know these days, right? So there are different business organisms in the UK pledging to avoid that kind of event, but still, Theresa May keeps saying that Brexit means Brexit. So I guess that's a combination of all those factors that is weighing sharply on the pound. And anyway, the market will see any kind of bounce or recovery as an opportunity to sell, no matter how US data came out. I believe I said this past week. No matter how the US performs, the fact is that the pound is bearish and will remain so for a couple of months, because I don't see how they clarify the situation a couple of months. In fact, I don't see how they can clarify the situation until the Brexit launch, whether in March next year or even after that. Anyway, sorry, that's just a personal view about how the market feels about the pound. The other factor that the market is pricing in these days is a probable picture of Mrs. Clinton in the US. You know, I don't have political sites, less in a country that I don't belong to. But as for what we could see in the media these days, the fact is that the scale has leaned toward Clinton's side after the two presidential debates. And while this is not, none of those debates has been a game changer for 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 the final result of the election. Sorry, that's what I'm trying to say. The fact is that um, Ms. Clinton is seen as a more stable person, and that she will keep on with current policies, It won't trigger new measures that can affect the financial market, nor the commercial relationships of the United States. So overall, it seems a bit more dollar positive than, than Mr. Trump, who is a wild card. It's a wild card. The market is not sure how he will handle relationships with China, with Russia, with Mexico, and whatever other country around the world, and why he will do that. And the case is that if somehow things point for a Trump win, we can see a lot of risk aversion across the board, right? So we are having risk appetite and dollar strength at the same time, uh, based on the election, the second debate result, right? That in fact it's a combination of both. Anyway, and when it comes to the macro calendar, I was surprised today with this new report coming from Germany. It shows that economic sentiment, business sentiment in the country and the whole region has improved sharply in October, ever since the September plumb. Sorry, I was disconnected from the internet. I'm back. Okay, sorry for the interruption. Here I'm back. As I was saying, I don't believe that this particularly Chinese data will affect the market, although it's irrelevant that China has come back after a long week of holidays. And it's also relevant for the markets that the yuan, it's trading broadly lower after the IMF included in a basket of currencies, right? So that will be another case for current dollar strength, base of a case, sorry. But I believe that during the week, trade balance to be released on Thursday, and of course, inflation on Friday will be key, okay, for China. If the data is negative, we have another support for the rally, okay? I'm not saying it will last, saying how things are. Anyway, we have inflation in France, Portugal tomorrow, industrial production in the euro area. As I was saying, I do believe that these readings, although they don't move the market immediately or trigger short-lived reactions when released, the fact is that this data is much more relevant for the market, for the whole euro outlook, than whatever we can get from a positive user vibe, okay? But of course, the start of the day would be Fed minutes. Uh, the promise of a December rate hike is still there. We are still waiting for it. Policymakers have been extremely hawkish. Someone was calling a September hike close call earlier this week. I don't even remember who said that. But anyway, what I'm trying to say here is that uh, policymakers in the US are really, really hinting us that they are going to raise rates in December, right? We have elections in November, so it's unlikely that we are going to have a rate hike before elections. But indeed, the market is increasing their hopes of a December hike. I do believe that we are above 60% of these dates. Anyway, uh, I don't know you guys, but when it comes to me, I'm losing hopes, of this always delayed promises coming from the U.S. Federal Reserve. But well, who knows? At some point, they will have to deliver if they want to maintain their credibility, right? Anyway, Thursday is fulfilled with data, but nothing really relevant. I do believe that probably German inflation, and if we have in jobless in the US could be the most relevant data to trade. I'm not seeing much more coming from the US. And finally, on Friday, as I say, the um, Chinese inflation, sorry. And I do believe that the center stage will be taken, but the retail sales in the US, market pays a lot of attention, even more than whatever the Michigan Sentiment Index can say. We have a speech for July also, but I'm not sure if she's planning to do an official statement on currencies, on rates, so not much relevant for me at this point. Anyway, let me change to charts, which are for me much more interesting that whatever the calendar has states. Indeed, I pay attention to news as everyone does because they can support or deny certain case in the market. Okay. Anyway, this is my daily chart for the euro dollar. Right. I have this ascendant trend line coming from November, December last year low around 105.05. Right. And the price is breaking through it today. Okay. It's also at its lowest level since early August. So indeed, we are having here a bearish breakout that still needs to be confirmed because we don't know if this daily candles will close below this trend line or not. But anyway, uh, this is quite a sharp bearish signal, and I expect the pair now to reach the 1040 region, which is the next support, right? Short term one, I mean. And of course, the next one is the 10 figure, okay? If we break below 110, I do believe that the pair can go not today, but towards the base of the range around 840, right? It was a major. Let me put on my weekly charts and enlarge it a bit. Okay, here we are, 840. Give me a second in the air, right? Take a look at the weekly, right? We have been a couple of times below that level, but the moves below it had been short-lived or quickly revert ever since early 2015, guys. So that's a key level. I don't see the pair breaking below 840 unless the Fed actually pulls a trigger. Okay, that's the level. So if somehow we keep on falling and reach that region, I don't know, a couple of weeks or maybe next week, I'm not sure if I will, in that particular moment, I will take a look at the situation. But I will, at this point, I'm more willing to buy near this level, 840, I mean, okay, than to risk yeah, another sell below it. Okay, that's what I'm seeing these days in the euro. Anyway, and after this breakout, 111, which 111.20, sorry, which was the low from this past couple of weeks, is for me the main resistance. If we recover above it, maybe the pair can go back up to 1160, and it will take a sharp recovery above this last to break above 112. But what I'm seeing also in the chart and beyond technical readings and technical indicators, sorry, is that the pair has been posting lower highs. It has been unable to settle above 112 during the last few days. So everything's pointing for a bearish continuation in the year, okay? And when it comes to the pound, well, this is the Friday's wild move. I was checking that post that move, and once the market stabilized, we had a low around 22.25. So I do believe that the next support comes in there, okay? And we have not much of historical data at this point because, it was 1985 the last time the pair has been at these levels, and I can't see that far away in my charts. But if somehow the pair breaks below this 20 to 20, I could say that 2160 and 21 are the next pro bearish targets for this week's. With the market, I thinking or targeting 120, right? Always those big round numbers are a huge magnet for market players. Okay, I can't think of a break below 120 this week. There's no big catalyst that can help us go through it. But indeed, if we somehow close the week below that level, I don't know, 116 seems probable for the upcoming month. Okay, but short term, I could set 121, and that's it. Okay, there's a immediate short term resistance around 23, 23.20. I would set better, right? And I have these lows around 23.60 lows high, which are the next probable resistance area, and some a level where we will probably meet some selling interest if a pair manages to move up to this. But I believe that the key now is 24.70, which was high post that plump. If you take a look at the charts around that region, the pair stalled multiple times intraday. And as long as below that level, the risk will remain towards downside. I have not much sayings on the dollar Japanese yen because it's again consolidating. The only difference from what we have seen uh, in previous weeks is that we are actually consolidating above the 100 simple moving average in the daily chart for the first time in months, right? So that's quite relevant for the bullish case, although there is this lack of follow through. It's bothering me lately, okay? Indeed, the period bottom around 100, it had recovered sharply, but it's doing it such slow motion, such, and as I said, and the lack of momentum. It's somehow scary, some because we are not sure if the pair will be able to continue. But as long as above the 200, the 100 simple moving average, at least I have line to my bullish case. The pair will probably advance as long as it holds above this level. If we fall below it, then the risk is back towards downside for me. Anyway, overall, what I can see is that the moving average are still very bearish, and despite the indicators have turned upward, upside in the daily chart, I would like to see some more upward momentum to confirm the rally, probably above this high in the 104.30-40 region. Okay. Anyway, so far at this point, the highest I can see the pair is around this Fibonacci area 106.60. Right, we have plenty of daily heights and lows around it, so I would say that if the bullish rally extends, that will be the level I will be looking as a major target, and where I will seriously consider to take profits and take a wait and see stance afterward to see if the pair is able to keep on rallying or not. In the short term, these previous highs and lows in around 30, 103.35 are my my first support, okay, followed by 120, 100 to 90, sorry, and as I was saying, the 100 simple moving average, which is around 100 to 65, right? And when it comes to the Aussie, well, um, the fact is that the pair has been unable to settle, sorry, above 77. We have discussed this plenty of times. We'd have lower highs. It finally broke lower today, despite the stocks are performing well and gold is holding tight in there, and we have a sharp rally in oil prices. Commodity currencies like the Aussie and the CAD usually follow stocks and commodities in their way up or down. Today, the decline seems to be more related with the fact that the dollar is stronger, right, than whatever is going on with commodities or stocks. Anyway, back sorry to the chart. We have set a low around 75.30. I would set that below that level. The next support chart 74.90 and the major 74.50 region, which it's the 38.2% of this year rally. The pair has bounced multiple times from that level and post sharp recovers. I do believe that this is like a line in the sun. If we break below it, the risk will turn sharply towards downside, and we will probably see the pair plunging uh, up to 72.50. I believe that we discussed this multiple times in the past. Anyway, 75.65 and 76 are my immediate resistance, followed by 76.30-40 area. I would set above this one. The pair will lose the current bearish tone and turn a bit more bullish. Okay, and about gold, and I will finish with this. We have this rally between May and July, right? And the pair has been, and the commodity, sorry, has been holding above this uh, 38.2 Fibonacci retracement. And well, you know what happened last week? We have it slumping through the level, breaking through 11300. I do believe that the break of the 1300 figure was probably the most relevant uh, factor of the following decline. But what I'm noticing this week is that the commodity, sorry for that, it's unable to recover above the 61.8% retracement of that rally. We had a couple of pullbacks to it, but the gold fell back, right? So I do believe that the case is bearish, sorry, in here. Dollar strength is not helping the case for recovering gold. Uh, I was targeting this 1250 region a couple of weeks before, and here we are. So I'm a bit lost on where to go now, right? But everything's telling me that the risk remains towards downside. 1240 in this lows is, of course, the first support. We can go first down to 1235, and I do believe that there's a stronger region level support around 22, 23. Honestly, uh, below 1200, I do believe that the commodity will pair losses, right? And will probably stabilize and look for an opportunity to recover ground. Don't forget that gold production costs it's 1100, 1150. So the price falling below that level seems quite unlikely, right? And again, I would be thinking of buying gold long term if we approach 211. Okay, uh, not something for this week anyway. As I said, this 1266 Fibonacci resistance is the first level to watch, right? And above it, 7750 is my next level towards the upside, up to the 50% retracement around 8710. Okay, so well, those are the lowest I will be watching for these days. Anyway, my time is done. So thanks for being here. Uh, Hope it has been useful and see you back next week. Okay. Thank you. Bye bye.